Thanks for coming. We have a great panel for you today about crypto hedge funds, and we're going to be talking about ICOs and regulation, market opportunities, and investing in crypto. So, yeah, let's kick it off by I'm going to ask everyone to just introduce themselves, where you work, what your fund does, and when you first got into crypto, as I know some of you have come from traditional finance backgrounds.
Hey, so I'm Nazir. First got into crypto in 2015 by buying Bitcoin for a massive premium, and it was still one of the best decisions I've ever made. I am co-founder of Neural Capital, a long-short hedge fund in space, also an advisor at Protocol Ventures, the first fund of funds, and CIO at Apex Token Fund, a tokenized fund of funds.
Hey, Mike Bucella. I'm a partner at BlockTower Capital. First invested in crypto in 16, not nearly enough, and then joined the crypto world in October. When I joined BlockTower, I was at Goldman for 10 years prior to that, mostly in trading.
My name is Sunnarborg. My first job was in investment banking. I left that in about 2014 when I co-founded a company called Lawnmower.io, which was a mobile app for investing and researching in cryptocurrencies. Ended up selling that to CoinDesk at the start of 2017, where I was a research analyst. And about 6 months ago, I started a company called Tetras Capital. We invest all across the crypto asset class.
Hi, I'm Lewis Fellis. I'm the Chief Investment Officer and co-founder of Bletchley Park Asset Management. Unfortunately, I only got into crypto in 2016, and that's mainly because I failed to turn on the mining rig in 2009. So it's been a long and painful path to here. Prior to that, though, I was working at the Harvard University Endowment, and a number of high-profile hedge funds are here in Hong Kong.
Great, thank you so much. So let's start off by talking about ICOs. So I know when I reached out to each of you and asked you for things you were excited about, and most worried about, some of you said ICO regulation for both, excited and worried. So I think, Ari, you actually said you were excited about it. So tell me about that. How are you feeling about ICO regulation? How is that influencing your strategy in terms of what you're investing in now?
So I'm excited about it because I'm pessimistic on the regulatory aspect. So I think a lot of ICOs are illegal money servicing businesses. And so I'm excited about buying very heavily discounted tokens in about 3 to 6 months.
Yeah, I would say, we're very specific about the projects we invest in. I would say, broadly speaking, the regulation coming into the space is actually making the project teams think about their distribution model, think about potentially the capital they're raising and how they're going to be utilizing it. So it's kind of enforcing an intelligent approach to the process, which I think in the end will benefit the ICO space going forward.
I would just add, I guess this incoming regulation is showing us some new creativity in deal structures. So some projects are looking to go purely institutional capital now and then do airdrops. We're seeing more pure equity structures. It's definitely a new trend and something that we're generally concerned about, but it's making people think harder and more responsibly.
Yeah, I would definitely share that kind of dual a feeling of excitement and also a little bit concerned about it. It's going to be a sawtooth profile whilst regulations being implemented. And I think what we'll actually see is, as soon as we can see regulation which approximates that within the equity space, it's going to be a safe time to get into ICOs. And I think that will be quite an exciting period.
Yeah, Lewis, maybe can you elaborate a little bit about your investment strategy? Are you, differentiating between live blockchain cryptocurrency projects versus ICOs? And how you invest?
Sure. Within that, whenever you create a hedge fund, you always have to marry the liquidity of the fund, what you promise to investors, then you have to marry that liquidity to the underlying investment profile of your investments. And as such, we have to limit our exposure to ICOs and also the path of that ICO to market to match the liquidity of our fund. So we're a monthly liquidity fund, and so you don't see us participating in ICOs where there's a 6-month lockup. It just doesn't match up with our investor profile. And so because of that, we limit the weighting of ICOs within the portfolio to a maximum of 10%. But in reality, it's a little bit lower than that just because of the regulatory headwinds we see in the near term.
Yeah. Alex, does that align with what your strategy is, or how would you describe it?
I'd say it's pretty similar. So like I said, we invest across the asset class, so we analyze deals in already live tokens to these pre-ICO SAFs as well. I would say we are heavily, we heavily favor sort of live blockchains or live tokens versus these pre-ICO SAFs for a couple of reasons. Most of these SAF deals are for decentralized applications. We generally think a lot of these decentralized applications have lower target addressable markets than some of these cryptocurrencies, higher velocities, and the regulatory risk also kind of comes into play with both sort of potential enforcement against the ICO issuers as well as potential delistings of tokens on exchanges. So it's a huge liquidity concern as well. Also, the lockups make us think about everything in terms of opportunity cost versus investing in liquid assets like Bitcoin. So for a plethora of reasons, we are generally extremely critical on SAF deals, but we do look at them.
I would say, you know, ICOs, the way the market is now, severely limits your ability to manage risk. And so having it as any component of your portfolio, you want to make sure that, one, the use case is valid, and it's coming at a reasonable valuation. And if you're deploying too much capital into this space, again, you run up against liquidity issues, you run up against, obviously, downdrafts like we've seen recently. This is a very volatile market, a very cyclical market, and these are the high beta components to that. So if you're truly managing risk, and as a hedge fund where you're trying to raise capital from institutional investors or responsible investors, you know, as a fiduciary, you should really think about the construction of your portfolio.
Yeah, to Mike's point, liquidity is one of the main pitches that any crypto fund makes to a potential LP. And so if you lock up too much of your fund into an ICO, you're actually going against what you're pitching to investors. There are some valid use cases. Any ICO that represents something like Omisego that you know, solves one particular issue for a blockchain, that's super interesting. But something that claims to be the next Ethereum doesn't really, you know, give you much beyond a white paper. There's no product. That doesn't make any sense for most people to do an ICO with. So
you're not really kind of just drawing a line between utility token and security token. It's more nuanced than that.
So that's actually an easy pass for us. If anything is a utility token, it's an automatic pass no matter how great it looks, because there's no such thing as a utility token. You're a security or you're not a security. It's as simple as that. I think the space is, unfortunately, you've had engineers try to out-engineer the law, and that never works. There's a reason the law exists, and it's better to just follow, you know, have lawyers comply with security regulations as opposed to try to make up a model to try to get around it so you don't have to file in the right kind of way, make the proper investor disclosures, which actually is just unhealthy for the space generally.
Great. Why don't we talk about what I think maybe is the elephant in the room I haven't heard a lot of people talking about at this conference yet, which is prices. They're down, what, 70% or something from December. I've heard at least one of you say, well, there may be some concern that we're in a long-term bear market. I'd be curious to see how concerned each of you is about that and how you're getting through it right now in your strategies.
So a lot of exercise, a lot of meditation. Just kidding. Yeah, I think it's pretty clear at this point we're in a bear market. The short-term bubble for Bitcoin popped on December 17th. I don't think we'll see a market like 2013 and 2014 where we saw a 58-week bear market, but for anybody to say we're still in a bull market doesn't actually make sense. We've had a 67 to 70% drawdown as of February. So at this point, it's really capital preservation in a bear market and then positioning ourselves for the eventual return, because the bubble didn't pop at 800 billion. If this is truly what we think it is and the future is a tokenized model for any security or any equity, this is going to go to at least 3 to 5 trillion market cap. So right now it's a matter of, I can't speak for the other guys, but raising money from LPs and positioning ourselves in dollar cost averaging into longer term positions.
Louis, I saw you nodding your head. When we start with you.
Yeah, I would agree with the fact that we are in a bear market. It's all the marginal buyers, the catalyst for getting them into the market have been taken out, the bans on social media. And so that's left us in this bear market where the only catalyst really to take the market higher is successful execution of projects. So the tokens that have come out there with projects that raised money maybe 18 months ago, it's really time to start to see them deliver. If they begin to deliver, the boost that will provide to the ecosystem overall could really kickstart the bull market again.
I think tokens absolutely got overvalued, especially in November and December, where it was obvious that basically a massive inflow of retail capital was just bidding up everything. I think it became most obvious it was generally uneducated retail capital in the fact that when you look at there's a huge trend in the actual cheaper tokens per unit price without paying any attention to supply, were actually those that were rallying the most. So, you know, these people were going on to Binance, seeing which tokens were cheap and rallying, and just throwing capital into it. There's been a narrative for quite a while that, you know, institutional capital is quote unquote right around the corner. I think people are seeing now that it's really a bit farther out than a lot of people expected. I think a lot of that has to do with just uncertain regulation around the world and immature custody solutions, as well as just the overall infrastructure of the market. You know, there's no ETFs, future volumes are pretty low. So how do we handle that? Generally by rebalancing positions towards things that we think make more sense from a fundamental value perspective. It's probably easiest to justify a asset being in the tens or hundreds of $billions worth of value if it is some sort of a store of value asset. So generally rebalancing our portfolio, and we also are very comfortable holding cash in times where we think the market is overvalued and then potentially buying in lower. So just kind of shifting and actively managing our portfolio.
I think it's kind of interesting. Yeah, it's an elephant in the room, but we're in a zoo, so you should expect to see an elephant. That's kind of how I think about it, right? This is expected. This market's volatile. It's sort of, I kind of consider it, the market structure is similar to distressed credit if you condense the cycle into every 3 months. And except there are no cash flows that bottom out valuations. There are no associated assets. So the cycles can be more vicious. I think, again, as you know, I think as hedge funds, and this is what the panel's about, you should be managing that risk. And you know, you get rewarded handsomely for being in a position to deploy capital when others can't. When you're a price maker instead of a price taker. And if you construct your portfolio appropriately, you should be in that position in times like this.
Yeah. Alex, you touched a little bit on when dealing with institutional investors and raising money. What is sort of the state of where we are now in terms of how welcome or how attracted institutional investors are into this space? What are you having to do to convince them, reassure them? Are you seeing them make the switch over?
Yeah, I think institutional capital, there's a huge spectrum of that. I think right now the institutional capital that's moving in the quickest is probably the family office type of folks. More of the venture capital firms and the bigger VC firms. They're just generally for them to move into the space, and why they're looking at hedge funds now to deploy capital through is it takes a lot of like operational expertise to analyze this new asset class. You know, it's very unlike the traditional stuff in their portfolio. Also, custody is a huge risk and just something that's not worth it for a lot of these institutions to move into. So a lot of these investors have questions on fundamental valuation, which they're used to from the equity space, which honestly doesn't really exist for the most part in crypto right now. It is heavily driven by speculation. But they really just want an understanding of, you know, how you manage your cash position, how you deploy these assets, when do you sell, how do you custody, but just an understanding of really, you know, how crypto works, because it's very different to what they're used to.
Louis, do you have anything to add?
I would just say, you know, it's the 3 C's: cash, custody. Sorry, 2. Cash. Mind slip anyway. Sorry, a little bit jet lagged. But the institutional money, you know, it is the cash, the custody, and they're looking for that killer app to come through. I'll remember the 3rd C a little bit later on. But it's important to remember when we talk about this wave of institutional money coming, the lead time on institutional money for just any traditional hedge fund that starts up is quite long. You know, if you were a new hedge fund launch and you were approaching an endowment, you would still be looking at least a 6-month lead time. And so when we add in these extra factors of the custody, the unknown asset class, the valuation, you need to add another 12 months on top of that. And so the institutional money isn't around the corner, in my opinion. They're looking at it, but before it hits this market, I think we're another 12 months away.
Just to add to that, I think as a hedge fund, the infrastructure of the market needs to develop significantly in order to deploy more capital. If you're going to be doing it in any active, risk-managed way, I mean, if you're a buy and hold, you can obviously deploy quite a bit. But I think in order to, for a lot of these, say a pension plan, a $50 million allocation is standard. I would say at this point, if you're over $500 million as an active fund, you're in a bit of trouble putting money to work. You very quickly become more passive than you'd like to believe.
Just to add some context to that, if I can, I mean, I would say there's probably less than 20 assets that trade with above $1 million active daily trading volume. This is fragmented amongst exchanges all over the world too, that most institutions or even retail traders are questionable to custody assets on. So really to manage a diversified portfolio, or especially to invest across SAFs or ICOs or some of these smaller altcoins, the liquidity is just not there for substantial capital. You're not going to be able to exit, and especially if regulatory crackdowns come on some of these exchanges and take away some of those trading venues, I mean, you'll just be sitting on completely illiquid assets.
Agreed with Alex, especially because there are certain exchanges, a couple of them in Asia, that apparently might have 80% fake volume. So even if you see 24-hour volume, you can't actually take that at face value because it might be significantly less. So family offices and institutions and certain traditional hedge funds, they're having a problem entering a space in which they can't verify liquidity. They can't figure out how to actually fundamentally value an asset like this. Anytime they talk to a crypto fund, the fundamental valuation from a crypto fund is more based on the protocol layer, what does the code look like, what's the long-term use case, and not cash flows or dividends or typical fundamental valuation aspects. I will actually disagree though on the custodial side. I think we'll start seeing the first products probably by end of Q2. There's Anchor Labs, there's a couple other third-party custodial services, BitGo bought Kingdom Trust. So I think the early movers, we might be seeing a head fake from a lot of institutions. And I think a lot of those will start buying in by Q3, and then Q4, and really mid next year is when we'll at earliest see the pension funds move in.
To delve a little bit deeper on the custodian issue, what would actually be required of a custodian if these are moving into market? What would you actually require from them or of them to solve that problem?
So verification of holding the assets, being able to verify independently. So currently, most crypto funds will hold their own assets on exchange or on cold wallets and on multi-sig wallets. However, certain assets like Monero are untraceable. So just because I tell you that I'm holding this because I downloaded the entire Monero blockchain onto a laptop and I hold Monero is not really good enough for most people who have fiduciary responsibility. So you need a third party to understand the technology and be able to verify that you do in fact hold the assets that you're claiming to hold.
And I would say the one thing that I think the one industry needs to step up, and hopefully someone will, is the insurance component. So I think if you can get insured custody, because technology is technology, and any custodian that garners the bulk of the assets will become a target. There will always be some group looking to disrupt that technology. I think once an insurance wrapper comes into play, that could actually increase the adoption significantly.
Yeah, I'd just like to add to that. I finally remembered my third C, cash, custody, and counterparties. And so the counterparty solution is, part of it is insurance, and I agree with you entirely on that, but there's also a balance sheet element to it. And so when you are pledging assets to a custodian, we need to know that that custodian has a balance sheet to support their business in the long term, and also to be able to process small errors when they occur. Because within the regular equity environment, we frequently see errors, and custodians frequently have to eat the cost of those errors. And so a small tech startup, whilst their solution may be fantastic, in the absence of a balance sheet, will struggle.
Alex, did you want to add? No. You guys talked about a little bit before when we were talking about using exchanges to trade versus not using exchanges. Ari, can you talk a little bit about that and how you approach that? Where are you finding places to trade
Sure. So almost everybody in the space will exclusively like to just use over-the-counter desks, such as Cumberland or Octagon. However, if everybody else is only using over-the-counter desks, there actually presents an opportunity to trade on exchanges, as long as you have withdrawal and deposit limits that are high enough for you to buy assets for slightly cheaper and then take them off, or be able to do short selling on exchanges if you are not set up with the proper places like Genesis or places that would let you borrow capital. And that the short selling aspect is actually pretty new. Genesis, if I remember correctly, only launched their desk about 2-3 weeks ago, but you had massive opportunities to short Bitcoin, Ethereum, Ripple, several other assets over the last year. So in order to chase the alpha beyond just being a long fund, you would have to take certain risks that would be, qualified risks that you would vet ahead of time, not just sort of shotgun cowboy style, and be able to short on centralized exchanges like Coinbase before their meltdown in the middle of the summer. Was actually a place you could margin trade, and you could actually short any of the 3 major assets that they listed. I think over time you're going to see Ledger and several other wallets will just start allowing that while allowing you to hold custody of your own assets. But for the time being, it's really on exchanges.
Yeah, I think that's very important from a trader's perspective, the synthetic exposure. If you can keep your assets in cold storage, we'll also have synthetic exposure to the exchanges, and there are some people that are working on that. That's very important. Shorting on exchange, really exchange arbitrage, anything where you're leaving assets on exchange, you need to be ready. You need to have done the diligence and understand what your risk-adjusted returns are, because if that exchange is hacked and your assets are pulled, you better be ready to answer to your investors. It's a very, very big concern and issue for a lot of hedge fund managers.
Yep, so that's obviously there's huge benefits to trading OTC, but I will add all OTC desks don't trade every asset, so you need to make the decision and weigh the risk of if you're trying to exit or enter positions in certain assets. It is necessary sometimes to trade on exchanges or even the growing world of decentralized exchanges, just depending on what exposure you're trying to get.
Yeah, I would just add to the issue around exchanges. There's clearly an optimization of the coins available, liquidity, et cetera, and the ability to go short. But the big hurdle we have when we appraise any exchange is the transparency and the information that's available to us from the exchanges. And again, to my earlier comment about the balance sheet, these are all privately held companies, and so it's very hard to understand how much cash they have on balance sheet. If you then pair that up with what is the policy around error trades, and generally the policy on any form of crash has been very, very positive in terms of making the ecosystem whole, but ultimately there's no formal policy. And so the exchanges, if they could provide more transparency, would probably win more market share, actually.
Okay, so when it comes to actually sourcing investments, one company that we've been talking a lot about lately is Telegram, which we all use, but I don't think anybody on stage here is actually invested in Telegram. Ari, do you want to start and talk a little bit about why that is and what made you skip?
Sure. The number one problem with Telegram for me, well, let me say the positives. The team is fantastic. There's definitely a use case. There's significant traction. They could build a platform that could work. What doesn't make sense for me is the people that are valuing what Telegram should be worth are using traditional equity metrics like daily active users, monthly active users, the amount of time spent in the app, and that doesn't necessarily apply to the crypto space. And so that was one of my biggest hesitations. And also, power to the entrepreneurs for raising non-dilutive fundraising, but Telegram doesn't need a token. To date, the token does not make sense, and the amount of literature that they have says, we will build something that will make sense, that will be a token that we will use, but that's not really good enough to raise $1 billion, in my opinion.
Michael.
Yeah, no comment on the investment side, but just broadly speaking, I think things like liquidity alignment, valuation, all come into play, and I think what they did that was, I guess intelligent from a regulatory perspective was only raising capital from institutional quality investors, a $20 million minimum subscription, and created mini syndicates, so that was interesting. A lot of family offices got involved in this, and unfortunately I don't think they understand, again, the token economics. I even hear from folks who are in crypto explaining to others, it's kind of like investing in Facebook before they had advertising dollars. And I said, And I said, that's absolutely wrong. It's basically like investing in Facebook token that you need to have be on Facebook. You never have affiliated cash flows from the advertisements. And a lot of traditional investment houses have a hard time understanding that. And so I think they'll understand it once, all is said and done with the Telegram raise, and once it starts trading and they start to gain a better understanding of token economics. But I think it's yet to be seen.
Yeah, just to reiterate a lot, it's just, what is the fundamental value and usage of the token? A broader question on top of that is, what incentivizes people to actually hold this token over time, aka keep the velocity relatively low? But the huge ones here are just like, they raised several $billion, so the valuation is several $1 billion north of that at least. The lockup is, I think, at least 18 months. And so generally that just gets down to, what's the opportunity cost of investing in Telegram versus just holding something like Bitcoin over that same time period?
Yeah, I would agree. It was just simply liquidity and valuation. It just doesn't match the fund profile.
Besides valuation, are there, when you're evaluating a new token, any red flags that would make you bow out or skip? Alex?
Sure. When investing into, I guess, SAF deals, unclear terms around the actual ICO, aka the date, the amount being raised, the lockup. Those are all clear red flags. I mean, I want certainty in my investment. I want to know when I'll have liquidity. I want to know what my valuation will be. And when I can't get any of those terms, it's really hard to jump in at that point.
Lewis?
Yeah, obviously the path to liquidity or the path to market is key. But right now the quality is shockingly low. If I were to appraise an equity investment, as a bare minimum, we would see a cash burn projection for the team and the amount of developers required. And sometimes these basic elements are missing, and that's a red flag straight away that they're raising an unknown quantity given the high volatility of the underlying assets being pledged, where there's no projection on this cash burn. So it's very difficult for them to model their business. It's even more difficult for me to understand it if I can't see a simple projection.
So I actually think investing into tokens early on, the venture style approach is very relevant. So being able to do due diligence on teams, seeing what they did before, why they're in the space, when they got in the space, what's their motivation is actually pretty relevant. And then being able to see if they have previous regulatory flags against them for doing any particular illegal activity or being illegal securities dealers would also be an obvious red flag.
Again, the flip side of that, when you, what are you looking for, and where are you seeing some of the greatest opportunities? And if you can give any examples, even better of what you're bullish on. I know some of you can't talk about that, but Ari, maybe you want to start.
Yeah, I can't give examples because I don't want people thinking I'm trying to shill them my bags, so to speak. But protocol tokens, anything that can allow for ICOs or for building distributed communities or distributed non-fungible tokens or assets, that's super interesting to us. Also, governance models that are different than just the Bitcoin model of forking whenever you disagree with a decision. So that also has like master nodes. I think what we've seen over the last year is a lot of people thought they became traders, but really it was a bull market and you couldn't really miss. So a lot of people are now either getting burned out or they're realizing that over the next few years, and especially over the next year, it makes more sense to have passive investments. So anything that has a infrastructure type investment that could resemble some sort of buyback, stock buyback. So a number of exchanges have tokens that fall into this category. Those are super interesting investments for longer term holders.
Yeah, I would say from a market standpoint, this resembles early 15 when mid-cap growth tech and preclinical biotech went through a massive bear market, and things that never traded at 2 times sales were trading at 8 times sales and coming to market through an IPO, and everything fell off a cliff, and everyone ventured back into the highest quality tech and healthcare names, and it took a very long time to get back down towards that tail, but in that kind of mess, there were some diamonds in the rough, and I think those could be interesting opportunities. I would also say this is probably a very good time for the hedge fund crypto hedge fund space to work with the developer community. There's some very, very smart projects and technologists in this space, and they're going through a very difficult time in a market. I don't think they were aware of what it meant to be in a publicly traded market, and so this is a time where you can sort of have that double bottom line effect where you have the economic return of the investment as well as the goodwill from the developer community. I think it's actually a pretty interesting piece of what could be the next cycle of this market.
I mean, to kind of build on what Ari said, just, show me what you've built before, show me what advisors that are in the space that are excited about your product, show me an MVP, and show me why people would hold this token over time as opposed to some sort of behavior like, let's use a hypothetical application, like a decentralized gambling application. Tell me why I would hold this access token over time rather than just buy this token, use it to access your marketplace, do all the gambling I want, and then at the end of the day, just sell that token right back. Like, what incentivizes long-term holding? I think that is what accrues value.
Yeah, and just to take that to the next level is, when the tokens come through, it's very easy to come up with the idea which is going to change everything, and we see that. And to build on Michael's point about our side of the business providing input to pretty much finding out what is the terminal valuation. And it's a recurrent question is like, what is the valuation? And so when we reach the steady state where these tokens are out there, we don't really want to sell them. And so I think people, when they're creating an ICO, need to spend a little bit more time around the game theory of what happens when this token's in a steady state. What volatility will drive it. Then we can actually begin from a game theory model to create valuations for tokens. Without that game theory at the terminal valuation when it's in a widespread usage, it's nearly impossible for us to ascribe a valuation to a project. And so I think somebody needs to make that first step of an ICO with an end plan where there's an equilibrium model that we can begin to create, or at least try to create a valuation metric for it.
Yeah, and one more thing to add. I mean, I would say, obviously, a lot of network value came out of the market, but network value doesn't equate to dollars, right? People can leave resting orders in a book and lift a market cap or a network value by 200% on $10,000 of volume. So a lot of the tail and the 95% drawdowns we've seen in the tail of early stage tokens or small caps, it was never real to begin with. I would say the benefit of this ICO, I would call it an ICO bubble that we've had, is it did draw in some dollars. And now there's a reallocation of those dollars towards projects that are meaningful, which is important.
Great. Well, I think we're out of time, but thank you so much to all of you, and hope you enjoyed the panel.
Thank you, Jen.
Thanks.